Kraken just got fined $30 million because of violations from the SEC. So let's talk about what happened. Why did they get their hands slapped for staking? And then what does that mean for us as investors going forward in the future? Well, Kraken is a crypto company that got a huge fine for doing what's called staking. And part of the penalty for doing this is that they actually have to end their whole staking program in the United States. The Securities and Exchange Commission in the US has said, not only are you getting a fine for doing this, but you have to actually end this program entirely. This staking program was a big part of why people got into crypto in the first place. And so now the SEC is seeing what's happening with it and they're cracking down. So let's talk about what staking is and why it was so bad that this fine had to happen and why they had to shut it down. The reason why Kraken got in trouble is they were doing something that counted as providing a security to us. That's a financial term, and they were claiming it wasn't a security. So when they didn't call it that, they didn't have to jump through any hoops, they didn't have to follow any rules, and they were basically operating in this gray area saying, oh, no. We're not offering a security to anyone. We're just doing this little thing on the side that we like to do to provide value for our customers. Well, a security is defined as a fungible, negotiable financial instrument that holds some type of monetary value. Typically, there's three types of securities, and they are equity. So that's like giving you a piece of ownership in holding part of a company like a stock. Debt is also a security. And so it's loans that we repay over time with payments. And then there's hybrids, which combine aspects of both. And so whenever these things are available to the public, that's a public sale of securities, and that gets regulated by the SEC. Overall, this is a really good thing for us because what it's doing is the SEC is trying to protect us from getting taken advantage of, because companies can make promises that maybe they can't keep, and the SEC is trying to be in the middle there to make sure that we don't get taken advantage of. So you might be thinking what I thought, which is, why does this count as a security? If I deposit money with somebody like Kraken or whoever, and they say, hey, just for depositing money with us, you'll earn a bunch of interest, almost like some kind of savings account. Why is that a security? I'm not owning any ownership in like a stock. I don't have any debt to repay. How does that count? Well, there's actually a 4-part test to prove if something is a security or not, and that's why Kraken got in trouble. Test number 1, there is an investment of money. This is what happens whenever we deposit money into something like a crypto account. That's what was happening with Kraken. Number 2, the investment is made to a common enterprise, which was also happening with Kraken. Number 3, the investors expect to make a profit from their investment. This was absolutely happening with Kraken because they were promising up to 21% interest for people who were holding their cash with this company. And number 4, any expected profits or returns are due to the actions of a third party or promoter. Part of the problem with this, and the reason why it took so long for the SEC to catch up, is crypto and crypto staking is such a new concept that people really had to wrap their mind around it and then be able to definitively prove that this was a security, which means that Kraken had to jump through the normal hoops that everyone has to whenever they provide a security, which means basically the new technology fooled everyone. This thing was such a new offering that we couldn't keep up. And it's confusing. I mean, unless you're a crypto expert, this feels like gibberish. What basically happens is Kraken takes your crypto, they put it into a staking pool, into a common pool with other people in hopes of earning rewards. So I already don't like that term, hopes. Then those rewards are metered out for being part of the validation process used by some blockchains. So, the part of what has to happen whenever a blockchain is being used is certain transactions and things have to be validated. They have to be proved, which gives the blockchain its value as far as keeping like a running ledger of what's happened. And so if you were a part of that proving process, then you would get this reward in theory. But what the SEC has claimed is that the returns that Kraken promised were untethered to any economic realities, and that the exchange provided zero insight into, among other things, its financial condition and whether it even had the means of paying the market returns in the first place. So that's part 1 of why Kraken got fined. There was basically nothing underlying proving that that money could be paid out to people who had trusted that they would earn interest on the crypto that they bought. And then number 2, also, the SEC takes issue with the lack of consumer protections that are involved, because Kraken had said pretty clearly in their terms of service or whatever it is, that they retained the right to pay them no returns at all. So Kraken was under no obligation to share profit. Like, let's say they benefited from you staking your crypto and making it a part of this process for the blockchain to function. Well, they don't have to pay you. Maybe they will, maybe they won't, but they have no requirement to do that. And that's a problem whenever we're doing money things in the United States. If you're putting your money on the line, you should be paid for that. You should have some kind of compensation, or at least stand to benefit in a way that falls under the regulations of the SEC. And that wasn't happening here. But Kraken really doesn't have a problem with that. And I think a lot of crypto services really don't, because they're still going to make money hand over fist. There's value in us putting our money with them. That's why banks make money. That's why investment firms make money. If we send them our money, even if it looks like they're just holding it there, they have ways to make money off of that. And so they're going to continue to profit off that, and Kraken is going to continue to offer the service outside the US. So if you're watching this video and you're not in the United States, you'll still be able to do this. You'll still be able to see, probably on their website, some ad, oh, we'll be able to pay you up to, who knows, 20% interest to just keep your crypto with us. And ultimately, that might be extremely risky, because not only may you not make any interest on it, but who knows, without any other financial protections really in place to protect you from being taken advantage of, any number of bad things could happen. So what does that mean for the future as far as crypto staking in the United States? Well, it says right here that the SEC wants this to be sort of a shot across the bow to other people who are trying to provide staking as a service, because they're trying to say, look, if you don't want to go the way of the Krakens, then you have to register this product as an actual security, which means you have to provide full, fair, and truthful disclosure to people like us who might be doing it, and investor protection. And as we look at the US SEC website to see the actual press release from them, I think that this has bigger implications for us as investors over and above, oh, one crypto company is in trouble, or this is another part of the fallout from FTX in 2021 and 2022 and that kind of thing. The problem with us as investors who jump on the bandwagon of a really new product like crypto staking or like some spin-off of something else that's new, is that it takes a while for regulators to catch up. It takes a while for people to sort of get their bearings and realize, what is this product? What are we being offered here? Is this something that's good for the average person? Or is this a way that this company is taking advantage of people? And in this case, it was found that this was taking advantage of people. It wasn't giving us the proper protections that we need. And so as investors, we need to look forward to these kinds of things in the future and go, wait a second, there's another big promise being made to us. There's another big claim saying that we can make all this money, we can have very little risk. Why would I not do this? Anytime we have that go through our mind of why would I not do this, there's always something else to understand. And there's always some other aspect of that we have to be aware of and sometimes protect ourselves against. There's a kind of false belief system out there in the world where people think that if something is out there available to us, it must have been vetted. Like if this car is being sold, it must be safe enough. If this crypto product is being offered, it must be legitimate. They must not be taking advantage of me because it's out there in the world. And the interesting thing about our culture and about our world is that you can get things out to market without them being vetted or checked or tested by anyone for safety or consideration of your overall well-being, which means that until those things are checked or until you do your own homework, you're putting yourself at tremendous risk to be an early adopter. So what do we do going forward? How do we figure these things out in the future and see the red flags for what they are? Well, number one, you've got to decide what you're willing to risk. If you feel like your back is up against the wall and you've only got $500 to your name and you're either going to win big or lose it all, that's up to you, but you'll be open to these kinds of really risky things at that point. For those of us who don't feel that much risk belongs in our life, for those of us who want to keep more of our money and then let it grow over time, we've got to rule these things out entirely. If it smells like a way better option than anything else out there, there's a reason, and it's because there's a corollary risk that may or may not be visible to us that makes it not a good option. Number one, we have to match up our willingness to potentially lose money with our willingness to try out a new thing. So that check for us is based on the claims that are being made. How good is the offer? The other thing we have to watch out for is just how new the product is. Anytime there's a new financial product out there that's unlike anything else that's ever been out there before, that automatically should wave a red flag in our mind to say, hold on, if this is a totally new thing, that means there could be risks here that we don't even understand yet. Maybe even the people who are making the product don't understand the risks yet. And it's difficult to be specific about that because who knows what will happen in the future. I mean, people thought the metaverse was going to be a big thing. It's kind of flopping, but maybe in the future that's a big thing. Maybe crypto has a roaring comeback and maybe there's new products that are developed because of that. But as our world continues to change and grow over time with technology, there's going to be new sectors and new products that are invented that, yeah, it could be interesting because you could be on the ground floor of this new thing and you don't want to miss out and that kind of stuff. But a lot of times, those things flop. In fact, the vast majority of the time, most of those things flop. So the two red flags are big claims that are unlike any other claim out there, and newness that's unlike anything else that's ever come before. Those two things should signal to us that, look, if I do this, there's a great chance that I completely lose this money. So it's almost to the effect of going to Vegas, betting everything on red, and hoping for the best. Those are your odds of winning and losing. Actually, those are probably better odds than whenever we do something brand new like this crypto staking stuff. And I personally experienced a little bit of this because I was investing, I was saving money through a couple of different savings accounts where they had a crypto sort of savings arm of their normal product. Because they had one arm that was rooted in traditional banking, that was like protected, that was like a normal savings account, all that. And then they had sort of a crypto arm where you could do something akin to this. You put your money in crypto, you earn a higher interest rate, everything seems great. And technically, I didn't lose money doing that because the companies I was using didn't get collapsed in the FTX collapse last year. But I want to just admit that I sort of fell for a similar trap. I didn't go directly to somebody like Kraken. I didn't go and have my money directly with them, which was even more risky than the sort of roundabout way that I did it. But I wanted that same thing. What? I can get a more secure, higher return. Why would I not opt into that? It sounds good. And I fell for the same traps, which is I didn't do my own homework. I didn't really read into the fine print. I didn't question it too much because it was so new. It was sort of like, oh, well, crypto's been around for a long time now. Maybe it'll be okay. And so in a way, I'm making this video as a word to myself, as a word of caution going forward to say, I need to be more careful about this stuff too. I ripped my money out of those crypto accounts and got it out of there because I just don't trust it anymore. And I shouldn't have probably ever trusted it. But if you were taken advantage of by some crypto company, or if you lost money, or if you had a similar experience where you had a near miss like I did, then we're in this boat together and we've made similar choices together. And so I'm not above this. I'm not better than anyone else who's done these kinds of things, looking down on you saying, you should have known because it was so clear. Who wants to read like a 45-page terms and conditions page? I don't want to do that. So in the future, I'm probably not going to read all those terms and conditions. And even if I did, I wouldn't understand all the terms. And I doubt you do either. How do we look at the SEC website? Even this article is hard to understand, let alone all the terminology and all the nuances of what financial terms and legal terms are. We won't be able to pick through that. But I think the question should arise in our head, if I need to be reading through the little specific nitty-gritty things of a contract or of what it means for me to stake my money on crypto, if I need to get that deep into it, maybe I shouldn't do it at all. If it's not already clear that this is an established thing that's settled, that we know how this works, it's probably too risky. I know there's still a lot of people out there who really like crypto and are really interested in it and think that it's the future of currency or think that it's a great investment, and that's fine for you. But I think that this kind of thing is really great to get cracked down on, because the problem is it's sort of a gateway to crypto. Whenever you think, well, I'm not gonna like day trade crypto, but maybe I'll deposit some money into this thing that's gonna get me this defined interest rate because it's based on a stable coin or because it's staked by this good company and they're claiming I'm gonna get 21% interest, and so that's safer. And the problem is it got a lot of us into the world of crypto. It broke down that initial barrier to say, well, I'm not really investing in crypto like those guys. I'm doing it in this safer way. So I'm wiser to do it this way. Then once that initial door was broken down, well, we're there. Then we're more tempted to buy and sell things. We're more tempted to use more and more of those products. And so I think the fact that they're rebuilding that wall that we had kind of broken down and went, oh, maybe it's okay. The SEC is saying, no, we cannot offer these kinds of things without them being legitimate financial products. This has to be something that protects consumers. So it's not okay. I think that means it's going to be a bigger hurdle to get people into the crypto world, which is far riskier than the normal stock market investing world or other kind of investing things in general. And so I'm hoping that what this does is in the future protect people from taking on undue risk when they really don't need to do this. There's other things we can do, that we can invest our money, that we can make good profit and not have to be super, super risky. If you ask somebody who's a really successful investor like Charlie Munger, who's a billionaire, what the number one rule of investing is, that's don't lose money. And this should help us do that. This video is a good one to watch next because it's about what are good investing services to use if you're kind of new to the stock market. And I think it's very entertaining and a lot of fun. The secret comment word for today is thunder because it reminds me of Charlie Munger. Munger Thunder. Thanks for watching. See you next time. Bye.